So let's now discuss this case study on standard costing. Now, standard costing, I know it is one of the most fearful chapters in cost accounting, that sir, standard costing is extremely difficult, but I tell you, this is one of the most interesting chapters if you understand the concepts. So understanding the concept, the conceptual clarity is the key, that how to interpret the question, how to interpret the information, how finding out the starting point on the question, that is the key. And you know, the conceptual clarity holds the most importance. So if you are still not clear with the concepts of standard costing, you can watch our videos on this channel. So please do not forget to subscribe to the channel, press the bell icon, because in the future also we are going to upload lots and lots of content. So if you are watching it right now, subscribe to the channel. And a small request to all of you, all those who are watching this video, that please drop in a Google review if you find our content useful, if we have contributed in any way to your preparations. The link you will find in the description of this video, right? So let's get started with the standard costing case scenario. Another very interesting case scenario. Let's see. K Limited is a manufacturer of a single product A. Okay, so this is your finished product. Manufacturer means this is your finished product. 8,000 units of product A has been produced in the month of March 2024. So this is what? This is your actual output given. This is what the actual output for a month, a particular month, right? At the beginning of the year, a total of 1,20,000 units of the product A has been planned for production. Now, what is this 1,20,000, sir? It is your planning at the beginning of the year. Can I say it as the standard output? Can I call it as standard output? Standard output for a year. Yes, I can call it as a standard output for a year. Okay, the cost department has provided the following estimates of overheads, that fixed overheads will be 12 lakh, variable will be 6 lakh, and semi-variable will be 1,80,000. Now these are what? These are the standards for standard output, standards for standard output. Because what is given, the cost department has given the estimates, that is, they have given the standards for what? For manufacturing 1,20,000 units in 1 year. Actual output is 8,000, but that is for 1 month, right? So you have to be very careful where it is monthly, right? Where it is yearly. That is why I have written here for a month and for a year, right? Okay, further, semi-variable charges are considered to include 60% expenses of the fixed nature and 40% of the variable nature. That is, out of this 1,80,000, what is that? 60% is fixed and 40% is variable. Sir, why we need to bifurcate into fixed and variable? Because you know that semi-variable overheads or semi-variable charges, they do not have a direct treatment. So we have to find out that out of that semi-variable cost, how much is fixed and how much is a variable cost. So they have given it directly that, sir, whatever is the semi-variable cost, 60% is fixed and 40% is variable. Okay, sir. The records of the production department shows that the company could have operated for 20 days, but there was a festival holiday during the month. Now, what is this? Company could have operated for 20 days, but actually there was one holiday in it. That means what they want to say here is that what is your budgeted days? What is your budgeted days? Your budgeted days are 20 days. Company could have operated, but what are your actual working days? Actual days is 19 days, right? So why do we need the days? In which of the variants, or in which of the variants we need these days and all? Fixed overhead variances, right? Where we use the calendar variance and all to calculate the possible hours, we use the budgeted days and the actual days. Remember that, okay? Now, the actual cost data, what is this? They are saying the actual cost data for the month of March are as follows: fixed overhead, semi-variable and variable. So this actual is for how many units? For 1 month, that means for 8,000 units, the actuals are given. See, very important point here that you need to understand and remember is the standards are given for 1,20,000 units, whereas the actuals are given for 8,000 units. Right? Standards are given yearly, whereas the actuals are given monthly. Is that clear? Okay. Now, the cost department of the company. Sir, what to do with the semi-variable cost here? Sir, the semi-variable cost treatment will remain the same, that out of this, 60% will be your fixed cost and 40% will be your variable cost. Clear with this? Okay. The cost department of the company is now preparing a cost variance report for the managerial information and action. You, being an accounts officer of the company, are asked to calculate the following information for the preparation of the variance report. Fine. What is the amount of variable overhead cost variance for the month? Right. Then fixed overhead volume variance, fixed overhead expenditure variance, fixed overhead calendar variance, fixed overhead cost variance. So these are the variances that they are asking for. So what we should be doing is, first we will be interpreting the information that is given. First, we will streamline the information, that what are the standards given, what are the actuals given, and how to deal with the things, right? First, let's talk about the standards what are given. Standards or the budgets. Standards or the budgets which are given. Right, what are the standards given? Now the standards, if you see, are given for 1,20,000 units, right? And this is not a monthly unit, this is for 1 year, right? What is the cost incurred on this 1,20,000 units? There are two costs being incurred. One is your fixed cost, one is your fixed cost, and another one is your variable overheads, fixed overheads and variable overheads. Now, what is the value of fixed overheads which is given here? 12 lakh and variable is 6 lakh. Okay, sir. So we'll write here 12 lakh of fixed overheads and 6 lakh of variable overheads. Anything to be added in this? Yes, sir. The semi-variable overheads, 1,80,000, 60% will go to the fixed one and 40% will go to variable one, right? Add semi-variable overheads. That is, for 1,80,000, 60% of it will go to fixed part and 1,80,000, 40% will go to the other part. So 1,08,000 will be added to the fixed overheads, right? And remaining 72,000 will be added to variable overheads. We are talking about the standards only up till this part, right? So what will be your total standard cost? That is 13 lakh 8,000 and here 6 lakh 72,000. Is that clear with this? We are talking only about the standards as of now. We have not touched the actuals. Now see, the actuals are given for the month, standards are given for 1 year. Now, can I find out the standards for 1 year? Oh, sorry, 1 month, not a year. 1 year it is given. Can I find out the standards for just 1 month? Because if you have to compare the standards with the actuals you have for 1 month, that means the standards also you need it for 1 month, only then you will be able to compare the standards with actuals. Is that fine? Yes, sir. Okay. So to calculate it monthly, what will be your monthly standards? What I'll do, I'll divide it by 12. Okay, I'll write it here. To calculate it monthly, I'll divide it by 12. Right, so 13 lakh 8,000 divided by 12 will give me 1 lakh 9,000. This is your monthly standards, right? And 6 lakh 72,000 divided by 12 will give me 56,000. Whether it will be used or not, I'll see. I don't know. I just interpreted on the basis that the standards are to be compared with the actuals, and for the comparison, I will have to bring the standards to the monthly part because actuals are given for month. Now, let's try to interpret the actuals. What are the actuals given? Let's try to understand the actuals now. Right, now, if you see, the actuals are given for 8,000 units. 8,000 units monthly. Again, the actual overheads incurred are given to you. Yes, sir. For these 8,000 units, what are the actual overheads given? So we have fixed overheads and variable overheads. Fixed and variable overheads. Fine. What are given? 1,19,000 and 48,000. 1,19,000 and the other side variable is 48,000. Anything else to be added? Yes, sir. This semi-variable overheads of 19,200, 60% of this will go to the fixed cost and the remaining 40% will go to the variable part. Okay, add semi-variable overheads. Add semi-variable overheads, that is 19,200, 60% of it will go to the fixed overheads and 19,200, 40% will go to the variable. So 19,200, 60%, that is 11,520, right? And the remaining is 7,680. So what is your total actual overheads? Fixed one is 55,680 and here it is 1,19,000 plus 11,520, that comes to 1,30,520. So these are your actual overheads. Is that clear? Any doubts in this thing? Any doubts in this thing? Are you clear with this? Yes. Okay. Now, what should be done? Now what should be done, sir? How to calculate it further? What else do we require? Now the next thing very important that we need is the standards for the actuals, isn't it? We calculated the standards or budgeted for standard output. For this is for what? This is for budgeted output, isn't it? This is for a budgeted output. We have calculated the actuals. We have calculated the actuals for actual output. Yes, sir. But very important thing that we need is what? We need standards for actual output for the comparison, isn't it? So next thing that we will calculate here is your standards for actual output. Standards for actual output. This is what we need to calculate now. And here we have seen that there are only two things which are involved. One is the fixed overhead, another thing is the variable overheads. How do we calculate the standards now? First we'll see for fixed overheads, how can we calculate? For fixed overheads, how can we calculate the standards for actuals? Very simple, sir. What are the standards for a standard output of 1,20,000? That is 13,08,000, right? What I'm saying is for a standard output of 1,20,000, my overheads are 13,08,000. Now, what I want to calculate the standards for actual output. So for an actual output of 8,000 units, what will be my fixed overheads? The standard fixed overheads for an actual output, right? So let's see. 13,08,000 divided by 1,20,000 multiplied by 8,000, that comes to rupees 87,200. This is your standard cost for the actual output for the fixed overheads, right? Similarly, we can calculate for variable overheads also. Now, variable overheads are how much? 6,72,000. So what I'm saying is for 1,20,000 units, that is your standard output, your cost is 6,72,000. What we need is for actual output. Actual output is 8,000 units. So 6,72,000 divided by 1,20,000 multiplied by 8,000. So you will get your standard cost for actual output. That comes to rupees 44,800. Right? So this is what you get, the standards for the actual output. Is that clear, everyone? Okay, so now can we move on to this MCQs now? Let's see. So what is the first MCQ? The first MCQ is asking for variable overhead cost variance. Now, how do you calculate variable overhead cost variance? that is standard cost for actual output minus actual cost. Right, now what is your standard cost for actual output? Variable overheads, that is 44,800. Yes sir. So 44,000. So here we will take 44,800 minus what is your actual cost? Actual variable overheads, that is 55,680 minus 55,680. So minus 55,680, that comes to 10,880. That is adverse or favorable? It is adverse because your actual cost is more than your standard cost. So that means we have option D here. Is that clear, everyone? Yes, fine. Now, what is the amount of fixed overhead volume variance? What is volume variance? That is standard cost for actual output minus budgeted cost. Right, now what is your standard cost here? It is fixed overhead. Fixed overhead standard cost for actual output is 87,200. So I'll take here 87,200 minus what is budgeted cost? What is a budgeted cost? The budgeted cost means the standard cost for standard output. Okay, sir. Now here you will take 13,08,000 or what? No sir, here we will not take 13,08,000. Why? Because 13,08,000 is the cost for the whole year. Whereas this 87,200 is for what? It is for 1 month. That means here we will take this cost 1,09,000. That is why I calculated this 1,09,000. That is the budgeted cost for 1 month. I'll take here because the standards we are taking for 1 month, the budgeted also will take it for 1 month for comparison, minus 1,09,000. Right, so 87,000 minus 87,200 minus 1,09,000, that comes to 21,800 adverse. 21,800 adverse, that is option C. Yes, let's move to the third one, that what is the amount of fixed overhead expenditure variance for the month. Now, what is expenditure variance? Expenditure variance is budgeted cost minus actual cost. What is your budgeted cost now? The budgeted cost is this only, 1,09,000, because for the month we are going to take, and the actual cost is what? 1,30,520. So I'll take here budgeted cost of 1,09,000 and the actual cost of how much? 1,30,520. 1,30,520. 1,09,000, 1,30,520. So it comes to 21,520. Again, adverse. That is option A. Right. Now, what is this? Amount of fixed overhead calendar variance. Now, what is calendar variance, sir? Calendar variance says that we can calculate what? We can calculate possible hours. We can calculate possible hours minus budgeted hours into standard rate. This is what we have studied. Now, in this complete question, go through the question and see if you can calculate the hours somewhere. If it is somewhere given the possible hours are given somewhere in the question. Just to read through the question once, whether some hours are given in the question or not. No sir, if you see, the hours are not given in the question. Right, there are no hours which are given in the question. So then how to solve this, sir? Trouble, no trouble when we are here, no tension when we are here, don't worry. So what I'm going to do is I'm going to open this bracket. So what I will write is I'll write possible hours into standard rate, right, minus budgeted hours multiplied by standard rate. What will this give me? This will give me possible cost. This will give me what? The possible cost minus what? Minus my budgeted cost. Right? Now, how to calculate possible cost? Just see here. Try to understand. We are talking about what? We are talking about calendar variance. In the calendar variance, that means there will be a roll of this budgeted and actual days, isn't it? How to calculate the possible cost? The possible cost says that This 1,09,000 is what? It is your cost for how many days? It is a standard cost for how many days? This is monthly. This is for 1 month, right? And in 1 month, how many days are there? Standard. Standard are 20 days. Standard are what? Standard are 20 days. So that means, can I say this cost is for 20 days? Because the factory is budgeted to be working for 20 days. So what I want to calculate here is, I want to calculate a possible cost. Possible cost. How will I find out the possible cost? That is, for 20 days, basically it is what? It is my standard cost for actual number of days. Standard cost for actual number of days. This is what I want to calculate, right? How will I calculate? For 20 days, my cost is 1,09,000. What is the actual number of days? That is 19. So what will be the cost for 19 days? Divided by 20 multiplied by 19. So 1,09,000 divided by 20 multiplied by 19, that comes to 1,03,550. 1,03,550. Right, so this becomes your possible cost. Now can we calculate? Yes sir, possible cost is 1,03,550. What is your budgeted cost? Budgeted cost is, sir, 1,09,000, right? Minus 1,09,000, that comes to 5,450 adverse. That means option B. Clear with this? Yes. What is the amount of fixed overhead? Cost variance. Cost variance is what? The standard cost for actual output minus actual cost. Right? Standard cost for actual output minus actual cost. Sir, we have already calculated in the first part. That was regarding the variable overheads. Now they're asking for the fixed overhead. So for fixed overhead, what is the standard cost for actual output? That is 87,200. So I'll take it here. Standard cost for actual output is 87,200 minus what is your actual cost? The actual cost is 1,30,520. So 1,30,520. So 87,200 minus 1,30,520, that comes to 43,320, again adverse. So option A for us. Clear? So with this, we are done with the case study on standard costing. A very good case study, I will say, right? One of the most interesting case studies on standard costing. But the thing is, you have to carefully interpret it. Now, if you have any doubts, go through with this video again. Try to understand where the calculations are yearly, where the calculations are monthly given. So that is one thing that you have to be very careful with, right? So just go through it. What all calculations we have done, try to understand, try to interpret on your own now after this video. Very important that once the video is done, you should go through it once again on your own. It's a kind of a self-study that you should be doing after this, right? It is very important, sir. Clear with this? Okay, so we are done with the case study on standard costing.